Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
Welcome to this week's episode of the Pete Wargent Property Pod. Very excited to have a regular guest back on the show, Michael Yardney, down in Melbourne today. Michael, welcome. It's great to have you on.
Thanks for having me back, Pete.
So, I wanted to get you back on, Michael, because last time we spoke, we didn't cover everything that I wanted to, and I don't suppose anybody has more experience over the decades than you do in terms of property market cycles, how to
That's
go about.
Because I'm going to be 70 later this year, Pete. I've been doing it a long time and made lots of mistakes along the way.
I didn't want to mention any numbers, but I knew you'd been around for quite a long time, shall we say. So the question I wanted to cover off today, one of the things I've thought over the years is that it makes sense to have a systematic approach to investing. So you've got a set of rules that you follow, and you're taking an unemotional and a rules-based approach. But then it got me wondering whether, if that is the case, can anyone succeed regardless of market conditions? And then it actually led on to this question, is property investment an art or a science, or is it a combination of the two? So I guess that's the subject matter for today, and I've got a few follow-on questions, but let's start there.
My way of thinking is if somebody else has done it, I can do it as well. So the answer is, can anyone succeed? Yes. Will most people succeed? No. We know the statistics show that of the 2.1 million property investors in Australia, Pete, there's only about 21,000 who own 6 or more properties. And I know you've seen many of those. I've seen some of those. And even they've got dud properties. So even those who've got 6 properties aren't what I'd call successful. So less than 1% of property investors succeed in the fact that they get financial independence from property. So that may lead us into the conversation that you want. Yes, one can succeed, but why not follow the footsteps of those who've already done it well?
Yeah, I sometimes wonder with those numbers as well, because the way those numbers presumably get picked up is from tax returns. And I know that I submit a tax return with more than 6 investment properties on, but so does my wife. And some of those are jointly owned. And but then by the same token, there must be a lot of properties that are owned maybe outright or in trust that don't get picked up. But I guess in the grand scheme of things, it's only a very small percentage of people who ever progress beyond, just a handful of investments.
The tax department reports those statistics and they call them taxable units. So it could be a trust, it could be a company, could be personal names, partnerships. So in fact, the total number of families, households are smaller because like you, I submit multiple tax returns. So, but you also asked me, and I'm sorry I interrupted, is property investment an art or a science? In my mind, it's true that property investors, successful investors, those that we talked about, they do research, they do need data. There is an element of science to it. But in my mind, it's not enough. You can't just look on the internet. You can't just listen to the podcast. You can't just do research. Maybe one of the things we could also talk about is why those 1% are successful. And in my mind, it's got nothing to do with the data or the science. It actually has more to do with their mindset. But that's probably the topic of another podcast.
Yes, that's right. Because, one of the things that I've seen you say over the years is that you follow a proven approach and you look for locations and suburbs that have always performed. But then I thought, well, yes, that is true. But then even within those suburbs, presumably you've got good and bad areas. And then there must be some nuances at the local level. It's not fully scientific. It is a mixture of, I guess, some local knowledge and a bit of market understanding as well as a scientific.
You have to know how to interpret the data, Pete, because there's so much there. So someone looking at the data, they can make it say almost anything they want. You know that. So the trick is knowing how to take that information and use it in conjunction with some practical experience, as you say, on the ground experience, in order to accurately make an investment decision. In other words, data and research are a critical step, but it's only one of the many important steps. There's no substitute in my mind for practical experience and for perspective. So how do people interpret the data that's coming now about what's going to happen to interest rates, what's going to happen to inflation, and what does it really mean for my properties or my investments in general or my business? And those of us who've been around a couple of cycles like you or me have got a different perspective, and we don't get as sidetracked by all the media noise.
When you're talking about taking a proven approach, you're looking at locations and suburbs that have performed well over a period of decades and probably less concerned about day-to-day and week-to-week market noise, of which there seems to be ever more.
Sure. I guess that's taking the long-term perspective, the big picture perspective, which is easier to do when you've been around a while and done it for a while. It's easier to do when you've already got an asset base than for a beginner who gets very nervous by the short-term factors that affect our values of our properties or our share portfolio. That comes with maturity and time.
Yeah, absolutely. Now, you mentioned there is more information around than there used to be. And I think sometimes there's almost too much data and information that gets thrown around. So what research do you actually need to do? If you're going to, let's say you're going to take a property strategy and you're going to research where to invest and what to invest in, presumably you start with some kind of a top-down approach. But what research do you actually need to undertake?
I believe the property's location is going to do 80% of the heavy lifting, and then it's choosing the right property in that location, which will make up the balance of its performance. So what makes a good property? What makes a good investment? I think, in my mind, to get wealth-producing rates of return from an investment, it's really the capital growth rather than the rental growth. To me, residential real estate is a high-growth, relatively low-yield investment, even though I know some people try to bastardize it and make it do something else. But Pete, what happened over the years when I changed my investment research criteria from looking at what's happened in the past to forecasting what's likely to happen in the future, I know I improved my performance, how I chose my investments, and also that of our clients considerably. So rather than doing the type of research that many people do, looking at how a location has performed in the past, I'd like to look at the factors that are going to drive location performance in the future. And they include things like demographics and population growth. In my mind, demographics is one of the major factors that's going to make a difference to an area's performance. I look at economic and employment growth because that leads to wages growth, and that leads to people being moving into the area to get jobs. It means people are going to be able to afford more. I also look at things like infrastructure and supply and demand. Infrastructure's sometimes a bit of an unknown. Supply and demand is more short-term, but we start with those big picture factors. And then I also look for multiple growth drivers because, look, we've all seen the results of those investors who've invested in single growth driver economies. The mining boom's obviously a really good example of that, but it's also the same in some of the smaller country towns. I like to see... maybe another short-term factor people look at is, I don't know, a big hospital's coming up there. I'm going to buy in that area because there's a hospital. That's, in my mind, in many ways, a single growth driver isn't sufficient to make that area outperform in the long term. So the lesson I'm getting at, I guess, in a long-winded way, is you're looking for multiple growth drivers for future property value growth and for future affluence of the locals, because that's going to drive long-term property performance, Pete.
Yes, that's an interesting question, actually, on the diversity of industry, because the risk is if you invest in a one industry town, which I have some experience of because I grew up in South Yorkshire, which was basically just a steel city in Sheffield. And then also there were coal mines in the local area. But then when those industries turned down, everybody left. So I guess you can get a short-term sugar hit from new infrastructure or from a booming industry. But if you're taking that long-term view of trying to build multi-generational wealth or even just building for your retirement, there's less risk involved in investing in a city or a capital city, which has a multitude of industries. So you're not reliant on any one particular driver. And I think the other thing, as you said, sometimes you can get a boost from something like, for example, Brisbane has the Olympics in 2032, and that could well prove to be a one-off boost for the city, which is great, but it's not necessarily the only factor that you look at because it could be a one-off, I guess.
Well, let's just look at what happened to Melbourne over the last couple of years. With it, 260-something days we were locked down. Shops were closed. Industry was stifled, hamstrung. Most small country towns, which fortunately didn't have those issues, couldn't have survived such a long time. I don't know what the next pandemic or issue or X factor is going to be, but I like investing in large cities with multiple growth drivers that can sustain themselves during challenging times. It means that if one or two of those factors falter, there are others supporting your property's performance, Pete.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
Every weekend now we get these sort of preliminary auction clearance rates and everybody gets quite excited for half an hour and then they come down again. And also every month we get median prices reported. And I think they used to be quite volatile, those median price numbers. I think the methodology is a bit better these days and the numbers seem to be a bit more consistent. But I suppose in the end, the median price is only a middle or an average, and it's not necessarily indicative of how individual suburbs or properties or locations have actually performed, like for like sales, I guess. So how useful are things like auction clearance rates and median price reports, or are they actually just background noise?
Well, you've just quoted the two most commonly referred to property statistics in the media. Yes, if you look on Twitter already, by 6 o'clock on Saturday night, people are communicating about what's happened to the auction results. Sunday morning and Monday, there's lots of news about them as well. In my mind, they're a good in-time indicator of what's happening. In other words, what the mood of the market is. But more important than what the actual auction clearance rate is the trends. They're more important. I think we all know that the auction clearance figures are fudged a little bit. Estate agents ring up the reporting houses and report their good sales, the ones that have done well. They're a bit slow in reporting the ones that don't go ahead. So it's not really till maybe Thursday, the end of the week, where you actually know what the full auction clearance rates are. And by that time, nobody's interested because they're already talking about next weekend's statistics. So look at the trend and see what's going on. But with regard to median prices, yeah, they're the most commonly quoted one, probably after auction results. In my mind, they're generally worthless. Look, my suburb that I live in Brighton, there are a number of areas. There's a section on one side of St Kilda Street, close to the beach, and they're very, very expensive multi-million-dollar homes in the Golden Mile. And then the next section is some older, more historic, older houses, terrace houses, even Victorian houses in North Brighton. Further down, there's lots of apartments coming up around the shopping centres. Then there's East Brighton on the other side of the highway. Within the one suburb, there are a wide variety of properties and different qualities of properties, yet they've got the same postcode. So if you look at the median prices in a suburb that is diverse like that, and that's just an example, median price is meaningless. Similarly, if there's suddenly been a new development of one-bedroom apartments, the median price, which is really the middle value of, if you've got 11 properties sold, there's 6 higher than it, 6 lower than it is the property price in the middle. That similarly, it's not a good indication. So in some suburbs where the properties are all homogenous, all similar, like some of the newer outer suburbs, yeah, median prices are more valuable, but in general, they're not. So just because the median price has gone up doesn't mean the median price of your property has gone up. And then over what period of time? Like with all statistics, the longer you leave it, the median price change over a year, in my mind, is more valuable than the median price change over the last month, Pete.
Yes, yeah, I guess if the median price in the city has gone up 20% over the year, well, it's a fair bet that overall most properties have done well, but if the median price changes by 1% in a month, well, who really knows? I think,
and even the city though, Pete, the city of Melbourne, Sydney, which is 5 million people. So people say, "Oh, I invest in a regional area," and they compare a regional town to a couple of 100,000 people to Melbourne, which has got 5 million people. That's not a fair comparison either. So to say regional Australia's done better than capital cities, you've got to compare a location. You've got to be more granular.
Well, yes. I mean, I'm thinking of Brisbane. Some of the suburbs have a high side and a low side, and then a Paris end, and then some housing commission. I mean, I'm thinking of an extreme example, actually. Hamilton has some of the most prestige homes, some glorious Federation homes overlooking the river, but then actually down by the river in the old docks, it's being fully redeveloped with higher density units. It's almost like two separate suburbs, and I guess it will be redeveloped for the Olympic Village. But it's very difficult to say a median price is very representative of what's happened there, given the amount of new builds and the different property types, even within one postcode.
I actually did a friend of ours took us on a tour of Hamilton when Pam and I were there a couple of weeks ago. We saw Christopher Scase's old house right on the top of a hill with the water views. Yes, there are some amazing properties in that suburb. So quite a diversity. So what does the median price mean? Nothing.
Well, now you are showing your age, quoting Christopher Scase.
Some people are going to wonder, who is he talking about?
I think I was still living in Europe when all that happened. So you mentioned your top-down approach. So let's step through your research and strategy process so that people can get a real understanding of, if you say you take a top-down approach, let's step through how you would actually go through that thought process.
Well, what we do, as I explained, is start with the macro factors affecting our property markets, and then we drill down to the micro level. So I start by looking at the macroeconomic environment, the big picture of how Australia's economy is performing. And in fact, that we catch up once a month and talk about that anyway in my podcast, because I like getting your perspective, an economist's perspective of what's happening in the world. And then if the general economy is doing well, I look for the right state to invest, one that's going to outperform the Australian market averages. And that's because, again, looking forward rather than in the rear vision mirror, looking at its economic growth, its population growth prospects. And my strategy is only to invest in the capital cities and not in regional Australia. Now, I know that a good regional location will outperform the poorer capital city locations, but that's not what we're going to invest in. So I choose within the capital cities certain locations as well, because that's where the bulk of the jobs are going to be created in the future. That's where most of the people are going to want to live in the future. Then within that state, we look for the right suburbs or group of suburbs that are going to not just outperform in the long term, in the averages in the past, but also ones that are going to outperform in the future. And if you look at research, you can actually find some suburbs have outperformed others by, 50 to 100% more capital growth over the last 10 years. And Pete, as I hinted at a minute ago, it's more about demographics, because those suburbs that outperform tend to have more owner-occupiers, where owner-occupiers want to live because of lifestyle choices. That's where locals can afford to and are prepared to pay a premium to live there. It's just like on the Monopoly board, Pete, there's the Mayfairs and the more expensive Park Lanes areas that people want to live in. And there's all those on the cheaper side that people, I guess, don't wake up in the morning and want to live there, but they got to live there because that's all they can afford. So in general, it's the more affluent inner middle ring suburbs of our capital cities we invest in. But we also check census statistics to find suburbs where wages growth is above average. Now, all this is there in the census. It's a little bit old now, but the next census statistics will come out later this year, I believe. And even within the suburb, as we said, within the same suburb, there's such a variety. So you've got to find the right location. Some livable streets are going to outperform other streets. Some properties will be more desirable than others. Some will outperform as investments increasing in value more. And that's the art and the science bit. The art, the perspective bit is understanding why one side of the street is more popular than others. What people look for is a northerly aspect that's important in what's going on in that location. And once you've chosen a suburb and once you've chosen a location, then it's the right property. So that's why I'm calling it top down. So for the right property, one that's going to outperform the averages, it's got nothing to do with price. Buying well off once isn't anywhere near as important as owning a good asset. So I look for properties that are going to have owner-occupier appeal. Not that I want to sell our property, but because owner-occupiers are going to buy similar properties, pushing up values in that area. It's particularly important, I think, in moving forward in this market where the more affluent and aspirational suburbs and the gentrifying suburbs are going to outperform, because those are the people that are going to be able to afford more. Over this cycle, property values have already gone up 20% or more, 30% in some areas, but wages haven't. So we're looking for areas where people's wages have gone up, where people have got multiple streams of income, because they're the suburbs that are going to continue to perform for the balance of this cycle, and they'll hold their value better as the cycle finishes off compared to the less affluent areas. It's not a judge of people, but they can't afford to pay more in those outer suburbs. So first of all, I look for properties with owner-occupier appeal. And then I like buying below intrinsic value. In other words, I want to avoid new, off-the-plan properties, things that come at a premium. I like a high land-to-asset ratio. Now, that doesn't necessarily mean you're going to have a large block of land. Family-friendly apartments in the right location can do well, but I'd rather have a house or a townhouse if we can afford it. And then I look for a property with a twist, something a bit different, something a bit special, something a bit unique. So if it's an apartment, let's make it a ground floor one with a courtyard or two car spaces, something that when it's for lease or for sale, it's going to make it stand out from the rest. I look for properties that can add value too. So, my strategy is to buy old houses, pull them down and build two townhouses or duplexes there. If not, it could be renovation. So I'm not just counting on the market, Pete. I'm actually manufacturing some capital growth, which will be more valuable, more important as this cycle moves on, because there's actually, I don't think the market's going to be as strong moving forward. So that's the basis of the top-down approach we use to find properties that outperform.
And of course, as we've spoken about on a previous episode, the financing part of that strategy has become ever more important over time, understanding how you're actually going to finance the investment approach. So summing up what you've said there, so it sounds very scientific, largely more science than art, I guess, but then also there is some art and interpretation of data and experience and some intuition as well, by the sound of it.
So you're right. Now, you talked about finance. I mean, all this, before you get to choose a property, we've spoken about the concept of having a plan, knowing what you want, because what suits me at my stage of my life and my budget may not suit you, Pete, or may not suit other people. So all this assumes you've already got a strategic plan, you know what you want, you've got your goals set, and you know what you need to do to get to achieve your financial goals. And so this property's got to fit in with where you want to head.
Yeah, exactly right. So at the time of speaking, so there's a lot of talk about will the Reserve Bank actually begin to increase interest rates, which is something we haven't had to talk about for a long time for various reasons. And there is some talk about whether that might turn over the market. And yet on the ground, it seems to be there's only about 200,000 properties for sale. And 6 or 7 years ago, it was nearer 400,000. So the market's pretty tight. Interest rates are still extremely low in historic terms. And we sort of badmouthed auction clearance rates, but they actually seem to be pretty strong to kick off the year. Plenty of, the bank's lending figures show that there's plenty of appetite out there for the market. So what do you think will likely happen this year, 2022? But then looking beyond that, you talk about investing in areas with rising wealth and wages growth. What do you think might be a reasonable assumption for the next, say, 10 to 20 years, particularly in those suburbs that you identify?
Well, looking forward for 2022, the election's coming up sooner rather than later. That'll be announced soon. And that's probably going to put people's decision-making on hold for a short time. And yes, interest rates are going to rise, but I don't think as much as the media or some commentators suggest. And I'm actually surprised that some commentators are suggesting a 10 or 15% fall in property values next year because of rising interest rates. What's going to make property values fall is if people have to sell and there's nobody there to buy them. That's what creates it. And overall, there's actually been very few times, I don't think there's been any occasion when the general property market in Australia has dropped 15% over a year. There's been short-term falls. We know Perth hasn't had growth for a long, long time. Certain segments have. But to say that the Australian property market, not there is one, is going to fall so much is a little bit ludicrous to me. The Reserve Bank doesn't want that. The government knows, whichever flavour the government's going to be in the future, that the wealth of Australia, people feeling wealthy, is going to make our economy tick. People are going to spend money. Businesses are going to create jobs if people are feeling wealthy. So the Reserve Bank is going to raise interest rates to stop the stimulatory effect of low interest rates. But unless we have a massive boom, they're not going to raise them, in my mind, to the point where there's going to stagnate the economy. They don't want that. They don't want a property crash as much as they don't want another strain of coronavirus. We know that you and I have spoken before about the huge cash buffer that Australians have saved. They've stashed their cash. Some people are suggesting it's 250. We know that most Australians have paid off their mortgages maybe 4 months in advance. So on that basis, there's a lot of buffer in the system. I can't see people having to get out of property. They'd rather eat Maggi noodles, Pete, than sell up their home. So I can't see in the short term or in the medium term those significant falls in property values that not just regular property pessimists, but there's been some interesting names more recently who've suggested that as well, haven't they?
Yeah, so I guess my thinking is an increase in the cash rate from 0 to 1. Okay, it's an increase, but it would still only be to 1%, right? So it would still leave overall interest rates at a historically low level. Yes, and as you mentioned, I think unemployment is going to be falling to potentially maybe 3%, the lowest level in half a century. So I don't think we're going to see much in the way of forced sales given the economy booming. For my sins, I was reading a research paper this week from the Reserve Bank. I think it was written in 2017 about why properties are selling less frequently than they used to. And I guess generally people hold properties now for 10 years because the stamp duty costs and the costs of buying and selling. And they actually predicted that as a result, people would build up these big mortgage buffers, and it could actually reduce risk in the system. And I think actually 5 years on, well, there is some good evidence, as you said, that people are actually building up big mortgage buffers that they didn't used to. It's a very uniquely Australian trade. So look, bringing this together.
If I could, though, Pete, answer your question about medium to long-term growth.
Yes.
We've experienced a once-in-a-generation property boom. What's happened is this 20% plus growth that we had was the aggregation of a number of factors: historically low interest rates, changes in preference of living because of COVID, and also, I guess, pent-up demand, because for a number of years beforehand, there was a number of factors related to APRA initially affecting investors, the difficulty borrowing an election in 2019 that held people back. So it was something that happens once in a generation. That won't happen again. Similarly, years beforehand, a generation beforehand, there was a boom in the 80s when finance, in the 90s when finance became easier, when there were other lenders that came out as well. So I can't see as strong growth moving forward. But really what's important, Pete, is real growth in your investments. In other words, growth after inflation. And if we are going to remain in a low inflationary environment moving forward, and a lot of people are suggesting it is, because if the inflation is going to go up, we're still talking about 2 or 3% inflation, and we'd be thrilled. Not the sort of 10% inflation I experienced in the 80s. I can see a period of lower capital growth in properties. There's nothing that's going to push up property values to the extent that happened over the last little while, as interest rates kept dropping and dropping since the global financial crisis. What that means is you can't just buy any property and assume it's going to increase in value and create wealth for you. That's why I believe moving forward, correct property selection is going to be critical. And that's, again, why I like the idea of manufacturing capital growth through renovations or development, if you know what you're doing. In other words, not just waiting for the market to do the heavy lifting.
Yes, yeah. So I think it feels like a cyclical low for interest rates and slightly different outlook for the next year or two. So look, bringing all of that together, you mentioned the top-down approach. You've got this effectively a six-stranded strategic approach. So I know that you're looking for properties that appeal to owner-occupiers as well as investors. You're buying below intrinsic value, high land-to-asset ratio. You're looking for that proven history of strong capital growth, and then also something with a twist, unique or scarce, point of scarcity, or something that makes the property special. And also you're looking for a property where you can manufacture capital growth or redevelop or renovate. So bringing all of that together in the current market, and you mentioned Melbourne has had 260 days of lockdown or whatever it was, I've lost count. Are there opportunities in today's market? And I'm asking about Melbourne, I guess, because you're based there. But what sort of areas or opportunities would you see today if somebody was looking to make a property investment in the current market?
Sure. Well, even though I'm based in Melbourne, my team knows Melbourne, Sydney, Brisbane well, and so therefore I've got a reasonable understanding of it. But having said that, is it too late this cycle? No, it isn't. But you can't expect to get the sort of growth everyone enjoyed last year, and you can't expect to get every property going up in value. I believe Melbourne underperformed last year because people wouldn't put their properties up for sale. They had to be properties for sale, but you weren't sure, could people go for open for inspections? You couldn't do outdoor auctions. You weren't sure, even if you sold the property, could you go and buy another property? Because in general, sellers are buyers and buyers are sellers. So therefore, people want to know where to move on to next. So there is still pent-up demand in Melbourne. I don't believe the apartment market's the right place to invest, even though apartments are currently, the gap between apartments and houses is bigger than it's ever been. I think apartments are going to catch up in Melbourne, especially when the borders open, which is now touted to be happening soon. That means that we're going to get international tourists, backpackers, we're going to be getting workers coming in as well, and that'll start to fill up some of the vacant apartments. I think it's going to be a year of strong rental growth, but I believe in Melbourne, townhouses make a great style of investment. In other words, modern accommodation on more compact blocks, if people can't afford a house, I think that's a better investment in Melbourne. And if you can't afford the big smoke of Melbourne and Sydney, I believe there's still some great opportunities in houses where you can buy a house in Brisbane for the price of a double garage in Sydney.
Yeah, that's all. That gap has been closing to some degree over the last 18 months or so, certainly in the popular parts of Brisbane. So, Michael, always great to tap into all those decades of experience. If people want to know more about your top-down and six-stranded approach, where should they go for more? I know you've had a number of books out over the years, but also much online content these days. So where should people go if they want to find out more?
Well, just go to propertyupdate.com.au, which is my daily newsletter. Last year, 2.6 million unique visitors, Australians visited and read articles there last year, or the Michael Yardney podcast, and then you can find out a lot more about my way of thinking about property.
Fabulous. Thank you so much, and look forward to chatting again sometime soon.
My pleasure, Pete. Thank you.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.